So I'm Simon. I'm working at Saxo Bank. I am heading our fixed income and also our mutual funds offering. I have built that up digitally in the last 2 years, and my focus now is a lot on the investor segment and investor clients. Yes, for sure. What we see now in the US are now the 10-year spiking to 325, which is dramatic and something that is now a theme in the market. So that has struck the market with a bit of fear. And yes, of course, higher interest rates, especially the US yield curve, impacts a lot of other economies. I would rather say it impacts the bond markets there before the economy. So, for instance, emerging markets, which is mostly either local currency or dollar denominated, is impacted first. So I'm pretty concerned about the emerging markets and the quite huge underperformance in the beginning of 18. So yes, for sure, US higher yields do have an effect in most of the other countries' economies. No, actually, I don't think so. I think the political risk premium in Poland is very small and will continue to be that, simply because it's a very strong economy, and also we can see that the Polish issuance is at 85%. So it's not really like a vulnerable bond issuance or bond market for that matter. Quite strong economy, so I will not compare it to any other political things going on right now in the EU, for instance, the Italian situation, which is quite different. In very short, so we have developed a digitized bond trading, and others has as well. I think the big thing here is that compared to equities, bonds is much more complex to digitize because it's not really traded on any exchange. It's traded towards a lot of different banks and counterparts, and therefore you need to build that methodology up to trade with these. So you cannot just have like a direct connection to an exchange and then place an order. It's a different way you have to approach it, and we have done so with the help of robotics. In that sense, you can actually assimilate to what you do in equity trading, but you actually have a much more complex backend, which the client do not see, so it's quite easy for the client. I think simply because two things. A lot of bonds do trade in large sizes. So for retail investors, it's quite hard to invest $50,000 in one particular brand or corporate bond. But now I think that is changing a bit, and we see more and more bonds trading down to $1,000 and $10,000. So we have added a lot also to our platforms. I think that opens the door for retail investors, and furthermore, the cost of trading bonds have been quite high compared to equities due to the quite wide spreads. I also think that is changing. We for sure think that we lead the way by having quite very narrow spreads on most bonds, simply because we end all bond trades into a big multi-dealer competition. Yeah, if we take Argentina as an example, I would say that is in a more or less a basket for itself. They have been, you can say, having a big problem with a quite high political premium for quite a long time. A couple of other countries is in the same basket, where you have an emerging market together with a quite fragile political situation. The other one is Turkey. I would say these countries are under pressure due to the fact that investors both fear the higher yields, and therefore they also want a very high risk premium, because it's very hard for investors to foresee the political development in those two countries. I think actually the whole U.S. yield curve is now, we can say, on its way to normalization, at least compared to the European yield curve, and that also brings in a lot of investors, both focusing, of course, on the treasury bonds, but for sure the corporate bonds. You now have blue chip names trading at quite convenient yield levels compared to just 1-2 years ago. And I think that attracts a lot of investors at the moment. For Turkey isolated, I think it's a combination of the fact that it is an emerging market economy, actually with a lot of positive opportunities. Problem here is the political risk premium is quite high. So as long as investors do not really trust the political announcements and are fearful towards what we see, they will be quite passive on investing in Turkish assets. So we need to have like a kind of really an acknowledgement of the market that you have foreign investors wanting to invest in Turkey, and that should come from the political situation in Turkey. So they need to more or less provide some market positive news, and then you will see investors rush back into that market again, because the yields are definitely coming to a nice point at this moment.
Okay, thank you very much.
Thank you.